Hey, what's up, everybody? It's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week, I'm going to break down what's happening with mortgage rates, housing, and the economy just the way you consume it best. So, if you're somebody who really just doesn't care how the clock's built and you just want to know what time it is, the next minute or so, it's probably for you. If you like to know how the clock works, stick around just a little bit longer. We'll give you some additional details. And then for my friends that really just need to know how the clock's built, I've got a deep dive towards the end just for you. All right, let's go ahead and get started. For my friends that just want to know what time it is, the labor market, it's losing momentum, and that's actually helping mortgage rates. Now, private payrolls, they came in much weaker than expected, and ADP, they showed just 22,000 jobs added in January, and that's less than half of what was actually forecast. Small businesses, they added, well, 0 jobs. Mid-sized companies added about 41,000 jobs, and then large employers actually cut roughly 18,000 jobs. Now, that tells us that hiring's slowing. It's not crashing, but it's kind of cooling. Now, let's go ahead and talk about rates. According to Mortgage News Daily, the 30-year fixed rate, it's sitting around 6.15%. The 15-year fixed is around 5.72. The FHA 30-year is around 5.75, and the VA 30-year is roughly 5.77. Now, rates have eased slightly, but they're still bouncing around in a pretty tight range. Now, for a quick refinance check, if your current rate on a conventional 30-year loan is, say, 6.875, 7% or higher, or a government loan, if you're around 6.5% or higher, it's probably worth having a quick conversation. It does not mean go out and refinance tomorrow. It just means that you should know your options, and you should know if there's a true financial benefit, not just a paycheck for your loan officer. Now, at the same time, housing prices are holding up better than expected. Prices were basically flat month to month, but they're still up year over year, and forecasts now call for roughly about 4.5% home price growth over the next 12 months. So the bottom line here is the economy's slowing just enough to ease pressure on rates, but housing supply, it's still tight, and prices, well, they're not falling. So if you just wanted to know what time it is, your work here is done, but before you go, please like and subscribe if you find this information helpful, and I hope I can count on you to share it with somebody who just needs some good, honest advice. Now, let's go ahead and talk about how the clock works. The Fed, they're not looking at just one report. They're watching trends here, and the trend right now is pretty clear. Hiring has slowed pretty significantly compared to last year. Layoffs are rising, and job openings are falling, and people are taking longer to find new work. Now, wage growth, it's also cooling, especially for people that are changing jobs, which also helps reduce inflation pressure. Now, that's exactly what the bond market wants to see. Now, on the housing side, builders still can't just flip a switch and add new homes. So even with affordability challenges, prices continue to grind higher. Now, that's why waiting for both rates and prices to fall has been such a dangerous strategy for so many people. Now, let's go one layer deeper, because this is where a lot of people get tripped up. And most people think that mortgage rates are the biggest driver of affordability. And they matter, but they aren't the most powerful lever. Purchase price matters even more, and here's why. If rates drop 0.5%, well, your payment improves. But if home prices rise 4 or 5% while you're waiting for that rate drop, well, you're borrowing that more money forever. And you can refinance a rate, but you can't refinance a purchase price. And in today's market, housing supply, it's still tight, and prices are still rising even with higher interest rates. So when buyers wait for the perfect rate, they often end up paying more for the same house later. Now, here's the part that most people miss. Affordability usually doesn't improve because rates crash. It improves because buyers build equity, they have rising incomes, and they have smart strategies that they use along the way. Now, that might mean buying now and refinancing later. It might mean using seller concessions instead of chasing an interest rate. Or it might mean just choosing the right structure for today, not for the headlines. This is why timing matters, but strategy matters even more. The goal isn't to win the rate game. The goal is to win the long-term wealth game. And the labor market, it's cooling. Housing remains strong, and rates, they're at a technical crossroads. So if you'd like help building a strategy, not guessing at timing, reach out anytime. And as always, a portion of everything that we do at the Shoemaker Home Team, it supports military, law enforcement, and firefighters through the Home Foundation. And on that note, if you know of a local 501c3 charity that supports our cause, make sure and shoot me a message. I'd love to interview them so I can share their kindness as well as make a donation. Now, I'm Doug Shoemaker, and I'll see you next Monday.